Good morning and welcome to the Killik podcast for Friday the 12th of February. So another tough week, and it's really a collective loss of confidence in central banks to deliver economic growth and support the growth rates that have been in the markets. We've seen that exemplified by the Bank of Japan, who cut rates last week, but we've actually seen financial conditions tighten as the yen has strengthened and therefore the Nikkei has fallen quite considerably this week. Equally, Janet Yellen, the Fed chair, gave a very balanced testimony on their economy this week, but the market is continuing to reject their forecasts for inflation and interest rates. So we've got a resultant significant deterioration in sentiment that's sort of started to happen in the middle of last year and really has sort of accelerated through to where we are now. So here you can see the deterioration, bullishness, and the increase in bearishness. This is despite a pretty satisfactory earnings season. So we've just been through the Q4s largely, and you can see here around 75% of reported earnings are beaten, albeit in many cases downgraded EPS guidance. Back in August, we obviously had the growth scare then. We went into the third quarter reporting season. That seemed to soothe and calm markets, but that really hasn't happened this time round, and the concern over disinflation has trumped those pretty solid earnings. So why are we so concerned about inflation? So here you can see inflation in the US market expectations have really come down quite rapidly. So we're now sort of looking at an inflation rate of around 1.5 there, which is as low as it's been since 2008. Here you've got the impact that has on the stock market specifically is because what you see is rates come down at the short end and the long end, but disproportionately at the long end of the rate curve because people are worried about longer term growth. So this is the spread between the 2 and the 10-year yield curves in the US, and the lower that goes, the lower bank margins go. So you've had this concern about bank profitability that's really sort of come to the fore this week and created a new leg down for concerns over markets. So as you can see here, this is the sector performance of the FTSE All World Index since the start of the year, and financials really have been the worst, down just under 18%. Rather sort of ironically, basic materials and oil and gas, which started this negative market and concern, have been the best performers on a relative basis. So the canary in the coal mine has been bank bonds, and specifically their subordinated debt, or CoCos as they're called, because those instruments can convert into equity, and they're the first not to pay the dividend coupons if the profitability of the bank deteriorates. And here you can see Lloyds CoCos, the level of yield you're getting on them has spiked quite considerably over the last week. So we've gone from 6.2 to over 7%. And that's in recognition of a heightened degree of concern on whether they'll be able to continue to pay those coupons. We feel that European banks are in a much stronger position. We've seen measures from the ECB really increase liquidity in the banks. Deposits have been growing rapidly, so they've recapitalized. So the capital position's far better off with that 800 billion euros being raised since 2007. And clearly the ECB is very much still there as a backstop. Specifically to Lloyds, we feel that the sort of net interest margin story that's out there in terms of profitability doesn't affect the attractiveness of the equity, because the reason why we're owning Lloyds is they've got too much capital on their balance sheet, and they're going to start distributing that away to shareholders. We're in a position where they are overcapitalized for the demand for loans in the UK economy, and that needs to start coming out of the institution and to shareholders. So we're still forecasting a 6% yield next year and up to 9% in 2017, which is clearly extremely attractive, particularly when we have news of Rio Tinto, for example, yesterday rebasing their dividend to respond to their earnings. So if inflation expectations are the key to the market direction, what's the catalyst for reversal in expectations? So we saw a lot of that in the chair's statement, the Fed chair's statement this week. So she's very much looking for oil and import prices to stop falling. That's reliant on some sort of OPEC coordination. We've got a rumour in the market that that's happening at the moment. Equally, it's reliant on a stabilisation of the US dollar, which has also happened this week. They're also looking for wage growth coming into the market as the labour market strengthens. Again, we saw that in the non-farm payrolls number last week. And again, overall, the survey-based measures for longer-term inflation expectations have been reasonably stable. They're not seeing a substantial deterioration in inflation within the US economy. So we go back to what the US economy is actually doing now, and we see GDP picking up in Q1 off the Q4 numbers. We see consumer lending growth now running at around 9%, wage growth annualized running about 6%, and employment growing at around 3%. And that, for us, is a fairly healthy situation and not commensurate with the deflationary outlook that markets are pricing in at the moment, and the interest rates being where they are, as low as they are. So looking at the week ahead, we've still got quite a big timetable of results coming through, less from the Killik list. So Heidelberg Cement on Tuesday is the only covered stock, but there'll be plenty of news flow coming through. That's it from me. Thanks for listening.